Hey, real estate investors, did you hear 100% bonus depreciation is now back into play? So, with the passing of the recent big, beautiful bill, whether you like Trump or not, he brought back 100% bonus depreciation. And now we, as investors, can use that to help us save on taxes. So, do I have your attention yet? How does that work? Well, you got to watch the rest of this video to find out. So, welcome to the channel. My name is VANG. I'm with the MoveSmart community channel here, where I help consumers to make their real estate move a smart one. Okay, so before we begin talking about this topic, let me make it clear, put out the disclosures so that the internet keyboard warriors and the haters in the comments below don't go crazy, okay? I am not a tax expert by any measure at all. I'm not a certified CPA. The things that I'm going to be talking about are only through my own personal research and education that I know of these things. So I highly encourage you to talk to your tax professional, talk to your CPA to verify that these ideas that we're talking about are actually applicable and legit, that you could use potentially if you wanted to. Okay, so first, let's begin by understanding why 100% bonus depreciation is such a highly coveted tax strategy, right? So to understand that, we got to back up a little bit. What is depreciation? So depreciation, this is what the IRS deems as certain components of a home that can be depreciated over time, because these components of a home of real estate, they wear out over time. So not everything can be depreciated in real estate. One of those things is land. In the eyes of the IRS, land is forever. Land cannot be depreciated. So normally you subtract the value of the land from the real estate building. Now there's only certain components of that building as well that can be depreciated, right? Only certain things of that building can wear out and depreciation be applied. So things like furniture, that wears out, right? So if you supply a furniture for your rental property, you can depreciate that, right? If you supply appliances, you can depreciate that. Things like the roof, that wears out over time. You can depreciate that. Now, certain things depreciate over certain amounts of time, right? Because certain things only last so long. So depreciation, some things can only be taken over a span of 5 years. Some can be 7. Real estate, residential in general, 27.5 years. If you have commercial real estate, I believe that's about 33 years, I want to say, maybe 38, I don't know. But anyway, with bonus depreciation, 100% bonus, by the way, 100% is very important. That means you can apply 100%, all of that upfront in year one. So why is that important? Well, essentially, you can maximize the amount of write-off that you can apply in year one. So what that does for you as a real estate investor, it makes your cash flow look better on paper, right? So what this means is that if you have a rental property and you made, $30,000 gross income, well, if you had $10,000 of expenses only, then your net income would be $20,000, which could have been taxable, right? But now you also have depreciation. So if you say, for example, that you had $40,000 worth of depreciation, now you can apply all of that year one. And so now you're actually taking that and applying it, so you'd be at zero or even, because then you can't get taxed anymore, but then you'd have an excess of negative $20,000 in depreciation as well. Now with that, if you meet certain special tax status, you can apply that negative $20,000 in additional depreciation against your W-2 income or the W-2 income of your spouse. And so now your taxable W-2 income becomes less. Okay, so very important. In order for you to actually be able to apply your depreciation against active W-2 income of yours or your spouse, you need to fall into certain special category with the IRS, right? One of those is REPS. REPS, real estate professional status. And so what that allows you to do is apply any excess depreciation against the W-2 income of you or your spouse, right? Now, how do you qualify for REPS? Well, you have to prove to the IRS that you do majority of your work in real estate or real estate activities, right? It is very hard to prove to the IRS, if they ever ask you, that you are a real estate estate professional if you already have another 40-hour full-time job, right? It's probably nearly impossible. I mean, I've heard that some people, very few people have been able to prove it, but they're going to ask you for all sorts of information, right? That you actually spend majority of your time doing real estate related activity. So one of the simplest ways that, some people think how to get reps is just to become a real estate agent. Now, just by having your license doesn't automatically qualify you for rep status, okay? So let me make that clear. You still actually have to work in real estate, okay? So you still have to be an actual real estate agent. You can't just get your license and, oh, magically you're reps. No, you still have to do real estate activity related work, okay? So that has to be the major makeup of what you do. Other things that you can do is be a real estate investor full time. If you manage real estate properties, if you're actively flipping, things like that, you could qualify probably for real estate professional status. So now again, that will allow you to maximize all of that 100% bonus depreciation. So there's actually another way that a lot of real estate investors are jumping into this strategy so that they can utilize 100% bonus depreciation without rep status. Okay, so are you ready to hear about how you can apply 100% bonus depreciation without needing to achieve rep status? Well, here it is. The extremely coveted strategy that a lot of real estate investors are utilizing to take advantage of 100% bonus depreciation is that they start investing in short-term rentals. So it's known as the STR loophole. And so in the IRS code, apparently, if you actively participate in the management of your short-term rental property, your Airbnb property, right? So if you're actively communicating with guests, decorating, whatever, right? You're actively doing things in that business because it is a active business activity. This qualifies you to use 100% bonus depreciation against your active W-2 income. So boom, game changer, especially if you are a high income earner, you and your spouse, right? And neither of you can become a reps status, right? So very cool. And this is applied by a lot of real estate investors right now. And that's why so many real estate investors are calling me to help them find a short-term rental. So how does it exactly work? Well, according to the big beautiful bill, if you have a property that you put into service, right, in 2025 before the end of the year here, it just has to be in service, meaning listed on Airbnb and ready for potential guests, you can qualify, right? And it is retroactive all the way back to January 2025. So if you would have bought something earlier in the year, as long as it's not before January 20th, you can qualify. You can use that property, right? And so if you put your investment property into service for short-term rental use and you actively manage it, meaning you cannot just hand it to a property manager and expect to somehow take advantage of this, right? You need to be actively involved to qualify. So again, you should probably talk to a CPA, tax expert, right, on all the intricate details, because there's probably a lot to this, okay? Probably a lot of stuff that a lot of us investors, people who research it, right, that we are missing out on. The minutia, right? So definitely talk to a CPA about this, okay? But, I'm telling you, a lot of real estate investors are using this strategy, and I've helped clients as well to purchase short-term rentals to do exactly this. But because 100% bonus depreciation is back, that is even more powerful because now you can use all of it. Because before this, actually bonus depreciation, and it had a couple step downs, right? So I think it was, 90, 80, whatever, right? So every single year it kind of drops off, but now it's back. So a lot of people are going to be taking advantage of that opportunity. So let's talk a little bit more about how do you come up with the depreciation for this strategy, right? And there is a unique way that you must follow. Okay, so the process of figuring out how much depreciation is there at your short-term rental property is through a process called cost segregation study. And sounds really complicated and fancy, and it probably is, but I've heard that you could do this yourself if you really wanted to. What that consists of is deducting all the items that are not depreciable, like the land, right? And then you go and you document and you take pictures of all the other components that can be depreciated. And so now you make an entire list, right? So it's like a report, and you assign values, and then you come up with a depreciation value, right? Based on the IRS guidelines. So that's kind of the gist of it. But you can also hire these tax engineering firms where they will send somebody out to your property that will take pictures, document, and they actually know what they're doing, right? They're trained professionals. This is what they do. And so they'll put together a nice fancy report for you so that you can simply hand it to your CPA. Everything's done correctly, and your CPA just takes the numbers and puts it into your tax return. And so boom, you can apply the depreciation correctly. And if you ever get audited by the IRS, well, now you've got a cost seg study that you can give them. So it's up to you how you want to do it. But just me, I would hire that professional. How much does it cost to do a cost seg? A couple thousand, so $1,000 to $3,000-ish from what I hear. Of course, it can vary depending on your location, things like that. But you also have to figure, is it worth it? Right? Is it worth it to spend that money on a cost seg study? Will the amount of savings, be worth it? So that's a question for you. I've heard that, you can potentially save more if the property that you bought is a more higher end property, more expensive, right? So you would definitely get more depreciation from something that has more value, obviously, right? So if you're trying to do it on a single family home that is relatively inexpensive, like $100,000 or $200,000 even, the amount of depreciation that you probably write off from that cost seg study may not be worth your time and your expense to do one. So generally, the more expensive a property, the more value. That is where you will get more bang for the buck there. Wow. All of that sounds amazing. I'm gonna go out and do this, but it almost sounds way too good to be true. Is there anything else I should know? Is there some kind of catch? And yeah, you're right. There is some catches to this, okay? So when you sell a property, the IRS recaptures some of the depreciation losses that you've taken over time. And, normally you take these depreciation write-offs over a very long span of time. Usually it's not all in year one, right? Bonus depreciation, right? 100%. And so if you took 100% bonus depreciation year one, and then all of a sudden you sell super quickly, maybe the next year, you might be in for a surprise when you exit the deal and the IRS asks for some of their money back, right? So be careful on that. And also, certain states treat depreciation differently, right? So talk to your CPA and know what rules are in your states for state income purposes. All right, so that is pretty much everything that I know about 100% bonus depreciation, and enough information for you to be dangerous with it. But I definitely, again, want you to talk to your CPA, your tax expert, right? Make sure you find out all the fine little details that maybe I did not know or mention to you, because I don't know about it, because I'm not a professional, right? I rely on my own professional to do my stuff for me, right? So don't just take my advice for it. Go check it out. Go verify it, okay? And if you need a real estate professional that actually is also an investor, is a short-term rental investor, and also is a loan officer as well as a realtor to help you implement this strategy, I've helped a number of out-of-state, out-of-city investors set up Airbnbs in the greater Milwaukee area. And really, it doesn't even matter where you want to buy, because now that I'm a loan officer, I can assist you on the loan side. If you're using a non-QM loan, like a DSCR loan, there's many states where I can actually fund those loans because we're not required to be licensed to do the commercial non-QM loans. So something very cool, if you don't know about DSCR loans, essentially you just need 20% down, decent credit score, meaning 680, preferably over 700, and your property just needs to be able to be self-sufficient, meaning that the income it generates should be able to pay for the debt service, right? So hence DSCR. So if you're interested in that and you want any more information, I actually have another video talking about how to buy short-term rentals. So check that out on my channel. And if you don't want to check it out, you just want to give me a call, hey, do that as well. So I'm happy to help you out and have a conversation and see if I can assist you with your investments, with your wealth building, and your tax savings. So if you found value in this video, I'd appreciate it if you hit that like button, hit that subscribe if you haven't subscribed yet, so you will get alerted to the newest videos just like this one. So thank you so much for watching this entire thing. I appreciate you. See you in the next video.